There's a couple different ways to use them. A lot of traders use them to try and trade in between, buy when it hits the lower band, sell when it hits the higher band. That's one way to use them.
Welcome back, traders and investors. We have Sean Udall on the line. He is the top tech stock strategist, and I'll have to admit you've made some pretty good bullish calls on the tech stocks here, and a few of them are running into a little bit of headwinds here. Let's start with your impression of the Facebook earnings were good, but holy smokes, did they bake that stock during the conference call?
That's right. So, I mean, here's the issue. In fact, one of your good guys there, Benzinga Lewis, interviewed me for a story on Facebook, and my quote was pretty much, well, I thought they were going to have a very good quarter, but the problem that growth stocks run into is when they hit a period or they hit that point where they've pretty much hit peak growth and that growth starts accelerating, the stock quits working, right? And so, as you weren't interviewing back then, but I loved Facebook when it was a $60 billion market cap company. Just absolutely. In fact, it was my second largest position. Then it went to 100, 120, 150. I think I was pretty much out of it by about $180 billion. So I've missed this last sort of 10% run in the stock, but it's been purposeful. I just think we could be in this era where they're going to have a much harder time growing. The other thing that I just sort of think is nearly laughable is sort of the consternation around Twitter and the comparisons that Twitter is still so much worse than Facebook. Okay, so after all, Twitter just did 115% growth year over year. Facebook did 60-ish and guided for 45. Twitter did 115 and guided for 94. So yeah, Twitter has a smaller revenue base and stuff like that, but it's kind of the same argument why people were asking me, hey, why did I like Facebook so much versus Google a year and a half ago? Well, hey, Facebook was at 35 to 40%, growing to 50, 55, 60 plus. Google was 25-ish%, decelerating to 22, 20, 18, right? So, there's these phases in growth stocks where they're sort of like the optimal investment when the price of the stock is reasonable given the growth, and growth is accelerating, or the deceleration is not that bad given the size of the company. So, by the way, I kind of think that's a theme. I think that's a theme right now, and maybe the next couple quarters is what are the tech stocks that emerge that hold on to their growth, and what are some of the big guys? I mean, what are maybe some of the former high flyers that start seeing some deceleration? I think this quarter we're definitely getting a taste of that right now.
Okay, so what do you do with the stock? I mean, relatively speaking, it's still up near within shouting distance. It's its all-time highs. The overreaction in the after hours of pre-market trading kind of stabilized it, but came back, settled around the $75 level. Twitter's following through on its downside. Buy, sell, or hold at this point.
I'm long Twitter, short Facebook. I'm not short Facebook right here, but I think you short Facebook into strength. And I think you can probably start shorting Facebook a lot into strength because it's still a very loved name. I mean, here's what was funny. What happened post-quarter? And what really caused the rebound? I actually thought the down 10% reaction in Facebook was about right. So, but what happened? Analysts love it. They defended it. It's still, I think one of the most popular, it might be the most owned name by hedge funds is Facebook. It used to be Google and still might be Google, but the bottom line is, I think there's going to be this distribution, and I'm a short on strength in the Facebook. Now, by the way, I have a long-term thesis on Facebook where I could get very bullish on it again, but a few things would have to happen. Primarily, they need to show me a new major growth driver. They could. Zuckerberg is very smart, really, and again, I love the stock when it was a lot cheaper. But yeah, I think you short Facebook into strength. I really do, and I think this whole long Facebook, short Twitter pair trade that is so popular, sort of with the hedge fund community and maybe the mutual fund community, I think that trade's going to break, and when it breaks, it could get ugly. So if you're, meaning it could get, if you're short Twitter, as it finally breaks through to, 60, 62, 70, and new highs, that's going to be painful. And then if you're still hanging on to a long Facebook trade, if it goes back down to 55 to 65, that's going to be painful. But so, by the way, that's sort of anywhere close to 60. I'd probably start getting pretty bullish on Facebook again. So it's more of a expectations valuation game. I don't think there's anything hugely wrong with the company. I will say I did not like the WhatsApp deal. I think they paid way too much for WhatsApp. I think that's going to go down in history as probably a pretty bad deal, unless they can pull a rabbit out of the hat and really do something with it. I just don't. I mean, I think maybe paying $3 to $5 billion, maybe $6 billion for WhatsApp might have made sense. But would they pay $20 billion or $28 billion or whatever the number was? I think it was 22 all in. That's a lot of money to pay for a company that's probably going to have a $100 million run rate. So we'll see what happens. But yeah, I'm a short Facebook in the strength and long other names against it.
With Facebook, I mean, they're obviously the Facebook, Google, Twitter. I mean, they're all fighting, viciously for those advertising dollars. But is it, maybe an alternative? And could you see this happening with Facebook? Is that they started charging for the actual service? I mean, how many users do they have? On Facebook, if they charged them $1, I mean,
Yeah.
Do you think that that's something, or do you think that the free is what people want to pay for, and that would really hurt the company?
Yeah, well, I kind of think it would hurt, because here's the deal: it's not free. I mean, what do we all do? We all use Twitter, we all use Facebook, Google, blah blah blah. I mean, the bottom line is there's an inherent. I mean, we're the users are the ultimate money makers for all these companies, because they get our data, they figure out what we like, they do directed marketing and advertising to all our wants and needs and desires, and they know a lot about us. And so really, the user community for all these platforms is way more valuable to advertisers because of the underlying data that they can get, right? Than it would be if they started charging people $1 or something for the use. So, no, does that mean there couldn't be maybe some private platforms or proprietary platforms or subscription-based models that any and all of these companies could try to implement? I mean, Google themselves definitely has some enterprise services. The Google Docs is a subscription platform for enterprise, and there's some other stuff out there. But I think by and large, I mean, these guys have really created a pretty darn successful revenue streams. I think what's happening at the margin, I think Facebook and Twitter are starting to soak in and grab a little bit of market share from Google. So I think one of the next things that could be really interesting in the next year or two is how does search revenue hang on to versus sort of more real-time geolocation targeted search or targeted advertising, which really that's Twitter's sweet spot, and Facebook has a fair amount of that too, right? I mean, you just saw IBM do a big data analytics deal with Twitter. How many more companies could do something just like that? By the way, I mean, I absolutely love that part of Twitter. I love the fact that Twitter licenses data. I think the big data, real-time geolocation targeting theme could be massive, could be absolutely massive for Twitter, and it's very, very much untapped right now. But people get it. Apple bought a company called Topsy, which exactly does that. They basically figure out big data implications for Twitter data, right? There's another company that Twitter bought themselves called Nip, which does that. IBM's getting into the game, so that could be very, very interesting. By the way, Twitter's a much better platform. You see Twitter doing a lot of those deals. I don't really see Facebook doing too many deals like that. So, again, very interesting space. It'll be interesting to see who hangs on or how search hangs on. I actually think the next sweet spot is going to be what company can integrate search with real-time social media data. I think that's going to be the next sort of holy grail in internet advertising. So far, I've yet to see anybody do it.
Okay, and we got LinkedIn earnings coming up. Any thoughts on that?
Well, okay, so LinkedIn in a lot of ways is like Facebook. When the stock was $50, $60, $70 lower, I thought it was a good bet ahead of earnings, right? The stock has made a huge run, so they've basically gone. The recent low was 135-ish, 145-ish. It's almost all the way back to 200. So it's tougher. It's a much tougher trade at 200 than it was at 150. So I guess I would be neutral on it. I'd have to see what they do. It wouldn't surprise me if they probably have a quarter that's maybe better perceived than what Twitter and Facebook had. But, I mean, put it this way. They're not going to do 115% growth over prior year, which is what Twitter had. Twitter, after this whole earnings season, people are going to look back and go, that Twitter quarter was frankly incredible. And the sell-off in Twitter was the stupidest sell-off in the whole group. And, in days to weeks, that will emanate. LinkedIn, I think, will be okay. But I'm just not. I'm not as ebullient on that name. Again, if it was $50 cheaper, I'd probably say, yeah, I'm long some LinkedIn calls and I'm long some stock, and I think it's going to be a great pre-earnings play. At this price, it's tough for me.
Yeah, I mean, you think about it, too. Now, last earnings, they blew it away. The street loved it. I mean, I don't know how many trading sessions in a row they took it up. And now, now they've given it all back here, and now you're basically at the same level that you were at before the last earnings. And, supposedly, I mean, I think they're going to have some high expectations for them to meet here. And if you go with the Twitter and you go with the Facebook, I don't know. I don't know if you could be real comfortable taking the stock long into earnings. Let's also talk about Apple here. I mean, I know you've been a perma bull, and Apple has had an amazing run here. Made a new all-time high in 6 of the last 7 trading sessions here. What are your long-term targets for Apple?
Still think it's going higher. And by the way, I've kind of been a perma bull. There was a period for almost most of 2012 and early 2013 where I did not like the name at all because I sort of saw the whole Android tidal wave crushing them and the lack of the response by Apple to make large screen phones. So now that they've addressed this, the typical phone upgrade cycle for Apple is about 2 to 3 quarters. Really, it's about 2 quarters. Well, so here's the difference. The iPhone 6s, which I collectively call the Twin Towers of smartphones now, I don't think it's going to be a 2-quarter upgrade cycle. I think it's going to be more like a 4 to a 6-quarter upgrade cycle. In fact, I think the upgrade cycle is going to run all the way until they get the next iteration of the iPhone. I think that large screen iPhone is going to sell super well too. I think we're seeing the early stages of a renewed huge market share swamp by Apple. The trick is, my long-term target on the stock is still right about 155, 150, 155. Now, I don't say that it's going to get there in 3 to 6 months. That's more like a 12 to 18 to a 24-month target, right? So, but the valuation case is there. I think we've said this before. It is, to me, one of the dumbest things in the world that Apple trades at a significant discount to the S&P 500. You arguably have the best company on the planet. So it should trade at a premium to the market, and it trades at a discount to the market. I think at some point when that equalizes, I start getting less bullish on Apple. But Apple's got a couple, the other thing people are forgetting is Apple's starting to get into digital revenue streams, something I've been wanting them to do for like 3 or 4 years. I think Apple Pay is going to be way bigger than people think. I think the health applications, the medical industry sort of software sales that they get into from the watch and from the new functions on the iPhone are going to be incredible. So, a lot of easy money has been made in Apple, right? I mean, I'm up, 70, 75, almost 80% on some of my Apple take. So, you can't be as bullish on Apple now as you could be 50% or 25% lower. But again, I think it's a good hold. And tactical. I mean, if they ever take 5 or 7% out of the name, I think it's fine. But yeah, I'm still bullish on it. I'm more bullish on Twitter, but I can't hold Twitter as big because it's just it's a weird stock. But the bottom line is there's other stocks I like better. I think have a lot more upside at this point. But it's still a really strong core name. I still am bullish. I still think it has 20, 30% upside or more. Each 10 points on it is going to be harder to earn than the last 10 points. So, that's the cautionary tale. But again, the fact that it still trades at discount to the S&P 500 is incredulous.
Okay, let's just talk about the activity, that we had a few weeks ago on the, the Ebola fears and whatnot. Did that knock you out of any positions, or did it give you an opportunity to buy some more?
No, it gave me an opportunity to buy some stuff because my style is sort of the anti-Momo style. So in fact recently I've been taking some stuff down. As the S&P nears 1985 to 2000 again, I'm more of a seller than a buyer. So I'll take certain positions up, but I'm trying to take my book down. Same thing before the whole Ebola thing. We were pushing new all-time highs. I was trimming some positions. But, at the same time, hey, I'm not going to say what's funny is I see a lot of people say, oh, God, I just made all this money. I didn't make money. I took a correction because I have more longs than short. So definitely the Ebola thing took a chunk out of my portfolio for a few days. But the super sharp V-shaped recovery we had, basically you got it all back in about 4 days if you stayed in stuff, right? Especially if you stayed in the high quality names. But like the perfect trade into that whole deal was Google was reporting earnings. They did report earnings into that whole Ebola scare market correction. And Google gave a tremendous price entry. Again, not a great quarter. They've missed, 3 of the last 5 or 4 of the last 5 quarters. But, Google down close to $500 was the typical no-brainer. Now, I'm not going to ride this for 20 or 30%. If I get about another 2 or 3%, I'm probably going to exit the trade. But that's a good example. That's the type of stuff I try to do, in a market. So I'm always, sort of stocks, individual stock first and then market second. But I definitely use the market to try to give me preferred entries and exits. So, we'll see. I'll admit, I'm a little surprised how fast we recovered here. And I'm starting to look at sort of tactical macro shorts again. But I also look at what the Fed said yesterday, and I kind of think, so the word everybody's going to say is that we're out of QE. I think that the Fed is basically buying maturing bonds. I guess we could call it, QE 0.5. The fact that they're not letting bonds run off, and so they're actually buying the maturing bonds back, in effect, to me, kind of still means the QE program is at least 50% in place. And to me, the Fed is still incredibly stimulative as a zero rate policy. I actually think we might have talked about this before, Joel. I think we actually get quite a bit more economic growth when Fed funds are back between 75 and 150 basis points. So I'm not one of these fans of zero bound. I actually would like to see Fed funds at least, something closer to 1%. And because I think there's a whole lot of weird things that happen in the economy where we don't get economic growth when rates are kind of perversely low. So anyway, that's kind of my macro view. By the way, I think we go higher. I think by and large, we could have a Q4 performance chase. Look right now, the Dow's up pretty big. So, in earnings are not that bad. I think the biggest thing with earnings is expectations got high. I think we have a little bit of a reset going on. But revenue growth is starting to now be about on par with earnings growth. So that's a tailwind to me, not a headwind.
Okay, we've had Sean Udall on. He is the tech stock strategist, giving us a good look at the earnings here from Facebook and Twitter, as well as commenting on Google here. Sean, thanks a lot for coming on. It's great having you, as always, and we hope to speak to you again soon.
You guys take care. Have a great day, everybody.